Alrighty then, broadcast number 2 for the 14th of February 2019. Happy Valentine's Day. I didn't say that in the last broadcast because I wanted to make it as quick as possible. So here we go then. This video is going to be called When is the next global financial crisis going to happen? This is based on research from BitMEX. They posted this research article on their website a couple of days ago. It's called The Anatomy of the Next Global Financial Crisis. I've just gone through it in its entirety and picked out what I believe are the most pertinent points. So I'm going to do that thing that I do, which is to give you this through the Chris Coney lens. Feel free to go to the primary source yourself, but you're going to get my take on it, okay, and a summary of it. A new thing I'm going to do today is every day I'm going to create a special coupon code which gives you 50% off Cryptoversity membership. So it's normally $59 a month. If you enter a coupon code, it'll give you it for like $29 a month. But here's the catch. The coupon code that you find in the description, it can only be used once. So basically the first person to use it, that's it. You'll get it for the day. And then you'll have to wait till tomorrow for me to create another one. So that's the incentive. So basically the first person to use the coupon code each day gets it for half price. And I think that's fair, rather than dishing out loads and loads of coupon codes for 50% off. So what I'm going to do, I'm not going to have to monitor my email because at the moment the coupon code doesn't automatically expire after one use. So I want to see if someone uses it during the live stream so I can turn it off because I don't want more than one person to use it. So, Professor Wally, thanks very much for the tip already. Buy your sweetie some crypto. Professor Wally is an absolute gem. Always there supporting me. Makes me happy. Let's get into it then. So let's do the TLDR first. If you just want to get the TLDR, too long did not read and bounce out, here it is. Since the 2008 financial crisis, risk has shifted from the banks to the asset management industry. What's the implication of that? Well, the implication of that is that a repeat of the 2008 banking crisis, where our retail deposits of cash, when they were under threat in 2008, that is unlikely to happen this time round in the next crisis because the risk has moved out of the banking system into the asset management industry. So instead of being the risk being in the banking system, it's in the corporate debt investment funds market and unconventional debt investment vehicles. This is where the system is most fragile, according to the BitMEX research. And this is some decent research. Can someone please tell me what the hell an unconventional debt investment vehicle is, please? I don't think they mentioned that in the article. I've been through it and I was looking for the answer to that question, but what the hell's an unconventional debt investment vehicle? Is that student debt? Is that auto loans? Let me know, will you? I actually don't know what that means. So that's the TLDR, basically. Now let's go into the detail. Bank balance sheets in developed markets are now relatively healthy. Let's go to the article where I've highlighted the first bit. It's a little way down. I've got a chart for you. Here we go. Just make sure that it's actually doing the screen share properly on the streaming software. Yes, it is. So here's figure 1. United States and United Kingdom banks aggregate capital ratios. So basically capital ratios are up from, they were about 5% in 2005, 6, 7, around the 5% mark. And then from there, they've gone up to 12%. That's, in absolute terms, that's still terrible, isn't it? Because there's still a lot of phantom value out there, but at least it's improved. So that's the de-risking of the banking system, and why the banking system itself is less risky than it was pre-2008 financial crisis. Next point. Financial leverage in the banking system and the packaging of mortgage debt as an investment product, that was largely where the weak point was. That was a big factor in the 2008 financial crisis. Like the collateralized debt obligations and subprime mortgages were packaged into these investment products and then sold, as securities. Well, that's happening less now. So that risk has moved out of the banking system. The risk has now moved into the asset management industry, like private equity funds. We'll get on to exactly what these asset classes are in a second. But basically, this is where the leverage has moved to. Instead of the banking system leveraging itself up, it's now the asset management industry that's using leverage, particularly in the corporate debt sector. Now, one problem with the asset management sector is it's rather opaque in terms of the data. So it's less regulated than the banking system. So what BitMEX have done, they've had to rely on the data that these funds are required by law to supply to the SEC. So that's where they're getting the data. Because they have to disclose for regulatory reasons, that gives us some insight into the asset management industry, and we can get a handle on their numbers, even though it's not completely transparent. So the lack of easy access to this data, it makes predicting a crisis in this sector more difficult because we have less data. We don't know where the black swans are going to come from. It's easier with the banking system because they're much more highly regulated and their reporting requirements are higher. Next point, the gearing ratio for the US private fund industry. Let's go on to that now. So further down, I've got another chart for you. Let me just find out where my orange highlight is here. It's figure 5. US private fund industry gearing ratio, which is the relationship between gross asset value and net asset value. So how much money are they borrowing to leverage these positions? When you look at it from this point of view, the left-hand side of the chart is the first quarter of 2013, and it goes along to the right. The blue line is the hedge funds, the red line is other. And the blue line looks pretty flat when you look at it from this point of view, doesn't it? But if you move on to the next figure and you add in derivatives as reported to the SEC, this is figure 6. And what we got here, this is US private fund industry hedge funds, the notional value of derivatives compared to net asset values. Now, when you look at it from this point of view, it's much clearer that there's an increase in gearing / debt starting in 2006, 2007 and peaking in quarter 1 of 2016, 2017, it starts to rise, and quarter 1, 2018 is where it's really peaking at an all-time high based on this data starting in 2013. Next point. The next part is where I see the underlying pattern that emerged before the 2008 financial crisis. This next bit we're going to talk about, this is where I see the same pattern repeating itself just in a different sector of the economy. So what I mean is the pattern is the creation of these fancy new investment products that are opaque in terms of their content. You know, like in 2008, there were a lot of these collateralized debt obligations that had toxic assets hidden inside them, and they were sold to municipalities and pension funds and so on who really didn't know what was in them, and they were toxic, and the people selling them sort of knew they were toxic. So this is just my view, by the way. This is the pattern I see emerging again in the asset management industry. So let's go down to new corporate debt vehicles, back to the article here. So this table starts to list some of these peculiar and very creative investment products that have emerged here. So we've got things like collateralized loan obligations. Ding, ding, ding on that one. CDOs, collateralized debt obligations. That was one of the sort of toxic assets from 2008. So now they're just calling them collateralized loan obligations instead. And I'm not going to go into the detail here, but BitMEX have a description and a breakdown of exactly what that is. Then you've got leveraged loans that are unsecured. You've got private debt deals, bond fund ETFs and mutual funds, private equity, and all the rest of it. So the key difference here that I've put in my notes is that it's private asset management funds doing it this time instead of the banks. But to me, the behavior looks very similar, very similar. And check this out. The leveraged loans one in particular, just before we move on here. Check this out. Leveraged loans. The Bank of England recently estimated the size of the leveraged loan market globally at 2.2 trillion and compared it to the size of the US subprime mortgage market in 2016, which was 1.3 trillion. So that means that this leveraged loan market now at 2.2 trillion is bigger than the US subprime mortgage market was in 2016 by a $900 million. Interesting, isn't it? Very interesting. So next, there are some charts that illustrate the growth in these investment products. So it's not just the table. Let's look at the real numbers here. Moving on to the green, let's switch back to the article here. Figure 7, the size of these collateralized loan obligations. What's the size of the market? Well, it's been increasing according to this chart from when was it last? It decreased from 2011 to 2012, and every year since then it has increased. Quite notably between 2018 and 2019. 2019, what's this, in the billions? Yeah, $600 billion as of 2019 when this data was collected from Citibank and the Financial Times. I think that's Financial Times, ft.com. Then we've got the size of the US leveraged loan market in billions. Not as clear trend, but again, starting in 2010, increased every year up to 2018 when we've got, if this is billions, this is nearly 1.2 trillion, that is. If it's 1,200 billion, that's like 1.2 trillion, data from S&P and ft.com. Size of the private debt market, increasing since 2010 year on year. And then we've got figure 10, size of the top bond ETFs targeting US investors, going all the way back to like January 2006. And it's an uptrend and an almighty one at that, with a few pullbacks, flattening over the last couple of years, but peaking up against the right-hand side of the chart. So if you want to check that out, go and check the data for yourself. I'm just glossing over it so this video doesn't turn into like a 3-hour war and peace on this research. Next point. Moving on to the corporate bond maturity wall. So corporate bonds becoming due. Let's see what we've got here. So I've highlighted this in cyan. So let me move on to figure 12. So here's figure 12. Corporate bond maturity wall measured in US dollars in the billions. So what we're looking at here is the dates when the US bonds are going to become due. Actually, this is wrong. This is not what I wanted to look at. We wanted to look at the final part of this paragraph where it says 880 billion US dollars of corporate debt in the US will mature in 2019. There you go. That's what I wanted to say. So this year, $880 billion of US corporate debt is due to mature. Then we'll move on to figure 12. So just before I do that, $880 billion of corporate debt is due to mature this year. Here's my view on that. If lenders don't have sufficient confidence in the economy, corporations are going to find less people willing to renew those loans. Because once people get their money back, unless they have confidence, they're not going to be, this is my view, they're not going to be as willing to lend it out again. They'd much rather hoard the cash for a rainy day if they expect financial crisis. So that's going to cause the cost of borrowing for corporates to rise because there's going to be less cash available and those people are going to demand higher yields for their loans because they perceive a higher risk in the economy. Next point. So this is now the chart that I pointed out in figure 12 here, the corporate bond maturity wall, which is the credit rating of the US corporate bonds that are outstanding beyond 2019. So let's have a look at this. Let's have a look. So the next one coming up is 2020. So there's a big old load of US corporate bonds maturing in that year. Below this, I want to go to figure 14 as well, because this shows there it is. Here's the credit ratings. Figure 14 is the S&P credit rating distribution of US corporate bonds outstanding by maturity. So from left to right, we've got years, 2020 on the left, 2034 on the right, and then from bottom to top, we've got percentages. And the colored bars represent the credit ratings. So long story short, you see a lot of yellow here, right? Yellow is corporate bonds that are rated with a credit rating of BBB plus to BBB minus, which isn't a very good credit rating at all. So what I take from this is there's a hell of a lot of US corporate bonds outstanding that's going to mature over the next 14 years. A lot of them, in some cases 40 to 50% of them, are rated BBB, which isn't the most fantastic rating in the world. So that's that point. Excuse me. Next point. Low volatility is leading to a real temptation to use leverage to get returns up to an acceptable level. So let's go on to the grey bit now in the article, which I've highlighted further down. So yeah, I'm going to summarize this whole section which BitMEX research titles low volatility environment. So this, I've just said it. Low volatility means that it's really hard to eke out a return, and it just creates as a trader. I mean, I'm guilty of this right now. I'll get onto that in a second. Low volatility just annoys you because the prices aren't moving enough to get a return. So your only option as a trader is either to sit out, which isn't an option for funds. Their clients want a damn return. They have to do it. Otherwise, the clients will go somewhere else. And then the fund's out of business. So they're almost forced to find yield somehow. And in a low volatility environment, you got to leverage up. So if like, as Bitcoin's dithering around, 1% a day, up and down, up and down, up and down, how do you enhance your return? Well, you leverage it. You leverage it up. And that's back to the asset management industry and the risk shifting into that industry. The risk is coming from their leveraging, to squeeze out more yield. Now, back to how I'm guilty of this. Right now, I'm trading on leverage on BitMEX. I'll come out with it. Just because there's a lack of volatility in crypto, can't make the same returns as 2007 when the underlying prices where you could just buy and hold and hit 500%. It's not happening right now. So I'm leverage trading on BitMEX. That's it. That's what I'm doing right now. In fact, I'm in a short trade on Bitcoin with 25 times leverage. Don't want to talk about that today, but if you would like me to do a separate video on that trade, walking you through it, let me know in the comments below. But it was odd that I put that trade on yesterday or day before, and then I read this article, and I'm like, wow, I'm almost mirroring the behavior of the asset fund industry, just because I see the same problem, and I see leverage as the solution, just like they are doing. So leverage is also particularly attractive for the asset management industry, especially when the cost to borrow the money to do the leverage is so cheap, right? The cost of borrowing is so low. And it has been low since 2008 because central bank base rates have been so bloody low. So it's just so tempting to borrow the cheap money and when you've got poor volatility and leverage it up and get better returns. So final point then. There's going to have to be a catalyst for the next financial crisis, but that catalyst is still unknown. However, here is how BitMEX suggests the sequence of events will play out based on everything we've covered today. So let's take a look at that. So here it is. The sequence of events can be described as follows with various different factors contributing to exacerbate risk. So number one, some catalyst occurs causing a sharp increase in volatility. Now, this is a problem because when you leverage up, you're assuming that volatility isn't just going to suddenly change because you're leveraged, right? And if volatility suddenly skyrockets, and if your position moves against you, that goes against you in a leveraged way. So I'm at this risk right now. If I've got a 25 time leverage trade short on Bitcoin, and volatility returns tomorrow, and it pushes the Bitcoin price up, right? I only need the price to go up by 4%, which 4% against me for my 25 times leverage to turn into 100% loss. So this is exactly what they're talking about. This is the risk of leverage trading. So some catalyst occurs causing a sharp increase in volatility. That's a problem when you've got a ton of investors with high leverage. Step two, then investors will need to quickly de-risk their portfolios, concentrating first in the most liquid assets or the most liquid markets, which will be fixed income assets. 3. In the most liquid markets, machines, i.e. bots and algorithms, dominate trading, and the machines are likely to all withdraw liquidity at the same time because everyone's using the same strategy, right? Everyone's using leverage trades, and their bots are programmed to say, if there's a sharp increase in volatility, de-risk quickly. If all the bots do that at the same time, though, oh my God. Number 4, that results in the fixed income markets becoming even more volatile. Liquidity dries up and becomes dysfunctional as retail investors then run for the exit. So the bots start it, and then the people freak out, and then they start trying to liquidate the positions in an increasingly illiquid market. Oh my God, that would just be horrible. Step 5. securitized bond-based assets, such as these fancy assets we've talked about, the CLOs and the bond ETFs, they trade at significant discounts to their net asset values. Well, why would they do that? Well, because people are just so desperate to offload it, they're even willing to sell it below market value before the value falls any further. Step 6. The contagion spreads across other liquid asset classes, such as equities. That means the stock market then gets impacted by it. Step 7. Over the coming years, the newly established components of the debt machine begin to dry up. Corporates struggle to refinance and the economy suffers. There you go. Corporates struggle to refinance. That's exactly what I said a minute ago. As this environment emerges, it's going to scare the crap out of most investors, and they're not going to be willing to lend their money out to corporations. So the investors are going to just hoard their cash. Corporates are going to be like, crap, we can't refinance. Corporates are going to have to spend more money refinancing their debt, paying higher interest rates. They're going to have less cash available. The whole economy suffers, their sales goes down, and it's a bloody repetitive cycle, isn't it? Oi. So while BitMEX suggests this sequence of events, we still don't know what the catalyst will be. It could be one of any number of things, such as emerging market US dollar crisis, high levels of leveraged debt in the Chinese asset management industry, passive ETFs. It could be high frequency traders. It could be a contraction of central bank balance sheets too quickly as they try and destroy all the currency that was created. A large unexpected corporate bankruptcy, debt crisis in the Eurozone, even a catastrophic consensus bug in Bitcoin causing volatility, and on and on and on, and all manner of possible black swans we can't foresee, because that's what a black swan is. Excuse me, it's an unknown blind spot. So, in conclusion then, do I have another bit highlighted here? I don't think so, no. That was pretty much it. So in conclusion, given the uncertainty that lies ahead, I don't want to leave you dangling here. So given all that, what the hell do we do? Given all the uncertainty that lies ahead, what's the course of action? The course of action is to take the time now to adjust our portfolios into an all-weather configuration with good diversification. So that was a lot of syllables. An all-weather configuration, right, with good diversification. So the way I would put this is, in a storm, metaphorically, if we were on a boat, in a storm, the primary goal is staying afloat. So in investing, my goal is not right now to maximize returns that aren't even there. My goal is to restructure my portfolio, and it already is pretty well structured like this, but restructure it in such a way for all possibilities. That's really the only thing I can think makes sense right now, given all of the unknown unknowns. When there's that much uncertainty, all you can do as an investor is just round out your portfolio evenly in all asset classes and then just weather the storm. So that's what I learned from the BitMEX research. So there we go. That is all I've got for you today. Thanks very much for staying with me for this episode of the Cryptoverse. I really did enjoy doing this research, and I think this is some fantastic research. I'll put the link down in the old video description as well. If you like the episode, please hit the old like button. If you really liked it, hit the old subscribe button. Has anyone used the bloody coupon code yet? Let's have a look. No. No, I thought someone used it. Just checking my email. Oh, no one's used it. I'll leave it there until someone does use it. So check the coupon code down in the video description. It's a one-use coupon code, remember. The first person to use it gets 50% off tuition to Cryptoversity, which has a bunch of crypto investing courses, which looks like this. So check that out. If you want to support the show, I'd very much appreciate that. It does take time to do this research. So go to thecryptoverse.show. If you click on the blue button, support the show, that'll take you through to Patreon when it loads. And here you can pledge, your support, $5 a month or more. The more you pledge, the more you get. Everything's detailed down the right-hand side there. Other than that, I'll be back with the next episode of the Cryptoverse when I think I've got something else valuable to say. Until then, it's me, Chris Coney, saying bye for now.